Hey everyone! Today's video focuses on something incredibly important happening with NIO, something that may not be obvious at first glance, but it's changing the entire game. While many EV brands are caught up in flashy launches and brutal price wars, NIO is quietly building a roadmap toward profitability, and the moves they're making right now are a big part of that journey. If you're someone who believes in smart business strategy, efficiency, and long-term wins, this one's for you. This is not financial advice. Please do your own research. Let's break down how NIO is reshaping its operations, cutting costs in unexpected ways, and steadily moving toward strong financial performance, all without compromising on innovation or growth. Let's begin with one of the most significant developments: NIO's aggressive approach to cost cutting. You might have noticed how their international expansion looks different from what other automakers are doing. Instead of investing in expensive infrastructure like standalone dealerships or flagship NIO houses in foreign markets, NIO is forming strategic partnerships to penetrate these regions. It's a leaner, more efficient way to scale, and it's paying off. Now, take a closer look at how they've been handling product launches. Remember the big budget reveal events with huge crowds, stage lights, and press coverage? That used to be the norm. But this year, we've seen a sharp shift. Instead of renting out large venues, NIO has been conducting virtual launches and unveiling vehicles straight from their factories like the ES6 and EC6, which were introduced at NIO Park itself. This digital-first approach saves massive amounts of money, and it's yet another sign that the company is prioritizing cost efficiency over hype. And it doesn't stop there. NIO has been restructuring internally as well. From consolidating job roles to reducing their workforce, they're streamlining operations across the board. Even their sub-brand ONVO has seen significant workforce cuts, about 40%, reportedly, but this hasn't hurt performance. On the contrary, ONVO still managed to deliver the second highest volume of vehicles in recent months. That tells you something. NIO is learning to do more with less. But cost-cutting is only one side of the story. What's really exciting is how NIO is using this moment to boost its gross margins. One way they're doing that is by introducing their own in-house chips, custom-built components that help reduce reliance on third parties and give them more control over performance and costs. These chips are set to play a pivotal role in driving profitability because they offer long-term savings while maintaining NIO's reputation for high-tech innovation. And let's not overlook what's happening with ONVO again. Even after downsizing, ONVO's projected gross margins are set to hit around 15% by the end of this year. Some NIO models like the EC6 are reportedly pushing above 20%, and in some instances even approaching 30%. There's a strong belief that the upcoming ET9 could blow expectations out of the water in terms of profit margins. So while the broader EV market in China is caught in a pricing war, NIO's CEO has made it crystal clear they won't be joining the race to the bottom. Instead, they're standing firm, refusing to slash prices and dilute their margins. And that's good news for long-term investors. It shows confidence, discipline, and a vision beyond short-term gains. In fact, NIO is aiming for a consistent 20% gross margin by the end of the year. And once they hit that number, the real game begins: profitability. According to the company, they only need to deliver 50,000 vehicles per month to break even. That includes 25,000 units from ONVO and 25,000 from NIO's mainline vehicles. If Firefly, their upcoming budget-friendly brand, is added to the equation, they may even exceed that target with ease. And here's the math that has analysts paying attention. At 50,000 monthly deliveries, NIO says they can maintain a gross margin of around 17–18%. Add Firefly's contribution, and we're potentially looking at margins north of 20%. For those of us who've been watching NIO take loss after loss in the stock market, this is the turning point we've all been waiting for. The truth is, the market has been skeptical. NIO's share price has struggled, weighed down by doubts over profitability. Many investors simply don't want to back a company that's consistently reporting losses. But that narrative may be about to change. Recently, a senior executive from NIO stated that when profitability does arrive, it will come fast and aggressively. That level of confidence isn't something you hear every day, and it's backed by tangible steps the company is already taking. Let's not forget every delivery they make at these improved margins brings them closer to that profit threshold. Every reduction in cost without sacrificing quality puts them on stronger financial footing. And every chip developed in-house, every efficiency measure, and every non-traditional market entry strategy pushes them toward long-term sustainability. What we're seeing is a company maturing, not chasing short-term headlines, but laying down real infrastructure for long-term success. And while other EV makers may be throwing money into expensive launches or dropping prices just to move units, NIO is choosing the smarter path, one that focuses on value creation and investor returns. To sum it all up, NIO is showing us what a strategic transformation looks like. They're trimming costs where it counts, innovating in-house to protect and grow their margins, and refusing to get dragged into unsustainable pricing wars. From online car launches to efficient staffing models and smart expansion through partnerships, every move points to a leaner, stronger NIO. If you're an investor or just someone watching the EV space closely, this should give you a lot to be optimistic about. With targets in sight and execution improving across the board, NIO's path to profitability isn't just possible anymore, it's starting to feel inevitable. So, stay tuned. Watch those delivery numbers. Track those gross margins. Because what NIO is building isn't just a better car company, it's a better business. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.